We'll give it here a minute, let everyone hop into our webinar for today, and then we'll get started. We're going to give it another minute or so. We got some folks that are hopping on for our webinar today. We'll give us another minute and we'll get rolling here pretty quickly. All right, we'll get going for today's webinar. Welcome, everyone, and thank you so much for joining us today for NAADD's first session of many, coined the development series. Today, specifically, ways to give and how donors can support your institution. We're pretty excited to have these sessions take place. My name is Jamar Thompson. I work as an Associate AD for External Affairs here at the University of Northern Iowa, and I get the privilege to serve on the NAADD Executive Committee. Part of the goal of the committee has talked about since this summer was providing educational opportunities for the development professionals in college athletics. And so you probably have seen communication come out regarding a number of series that we plan to do throughout the whole year. This being the first one, focused on ways to give. And we have some distinguished guests, which we'll introduce here shortly. But you will see further information about upcoming sessions regarding the development series, specifically on securing gifts from corporate and from private foundations. Coffee with a NAADD executive committee member. There will be 2 sessions of that. Estate planning and estate giving and how to be successful with donors working with estate gifts. And then wrapping up, leading into the convention, especially those who have never been, what to expect and know before you go. Today, we have an hour set aside for our panelists to go through the topic of ways to give, including a professional advisor and then 2 colleagues within the industry of athletic development. So if you have questions as we go throughout today's NAADD webinar, feel free to throw those into the chat. We'll try to address those as we go, or we'll try to address those at the very end. We have an hour set aside. Excited for our conversation, and thanks again for joining us. So let's begin. One of our presenters today, I'd like to introduce is Scott Cernett. Scott is the CEO and founder of Cernett Wealth Management. He's had the privilege of serving clients, individuals, business owners, corporate, bank, and ESOP market clients for over 25 years. He also graduated from the University of Northern Iowa, where he also was a football student athlete. Scott has 4 professional designations: certified financial planner, professional chartered life underwriter, chartered financial consultant, and accredited estate planner. Scott married a high school sweetheart, Meg. They reside in Cedar Falls, Iowa. And then when it gets cold, they get out of here and go to Scottsdale, Arizona. They have 2 children, daughter Taylor and son Benjamin. Scott enjoys family time playing golf, which he's a mediocre golfer, traveling, working out, and reading and giving back. Coming from the development side in athletics is Michael Thomas, serves as an associate AD for major and principal gifts, senior development, director of development at the University of Cincinnati. In his role, Michael serves as a member of the department's leadership team, where he's a sport admin for the UC women's golf program, instrumental in the planning and execution of major gift strategies, fundraising campaigns, and capital projects. Michael has worked with the University of Minnesota, New Mexico State, Florida Gulf Coast University, and the University of Northern Iowa, and the University of Missouri. Michael graduated from Missouri Valley College, where he was a basketball student athlete and earned a master's degree from Missouri Baptist University. And our last presenter is Kirby Mills. Kirby serves as a Senior Associate AD and Chief Development Officer at the University of Maryland. In his role, he oversees the fundraising efforts for Maryland athletics while serving on the department's leadership team. Kirby has worked at Arizona State University, the University of Wisconsin-Whitewater, and University of Maryland. He's a graduate from University of Maryland and continues a family legacy of 3 generations who attended Maryland. So this is our panel for today. We're pretty excited about the topics we're covering. And as we go forward with our presentation, if you have questions, submit those in the Q&A, and we'll try to address those as we go. With that, I will turn it over to Scott Cernett.
All right, thank you, Jamar, and good afternoon, everyone, or good morning, depending on where you're at. It's just afternoon where I'm at in Scottsdale today, and I'm excited to be with you and looking forward to this presentation. As Jamar mentioned, this is an educational series, and I think my first disclaimer, first of 2, is that no one has a corner on the market on good ideas, and that includes me. And so oftentimes in this space, people don't know what they don't know. And so I've been a presenter as well as a participant in these types of programs. And so I'm going to share a little bit of my experience today, but we're going to cover a lot of ground, but we're going to also try to keep this very practical and have an opportunity for you to answer questions. So this is our agenda today. We're going to talk about an overview of charitable giving, and then various tools and how they work, working with professional advisors, and we'll have some time for Q&A as well. And go ahead, Jamar, you can go to the next slide. My second disclaimer is we don't give tax or legal advice in my business. I'm not a CPA or an attorney. I'm a financial advisor. So those are our 2 disclaimers. So first of all, to sort of firm up the topic, let's think a little bit about why people give and an understanding. It's not just about tax deductions, even though I think for tax and financial folks, that's often one of the first thoughts that crosses our mind is motivation for tax deductions. Certainly that's one element, but it's not the only one. So 2021, this is just a little bit behind, but about $500 billion was given to charities in 2021. And about 2/3 of that was by individuals, as you can see in the blue pie chart. About 20% by foundations. I think there's a section, Jamar, on foundations in the subsequent series. So, and then 9% by bequest, and about 4% from corporations. So most of the giving out there is taking place from individuals, and right behind that is foundations. Okay, next slide, Jamar. Where the money goes, interestingly, about 27% goes to religious organizations, and right behind that, 14% is education. And I didn't dive into the weeds on this study, but I believe that also includes, what we're here to talk about today is athletic giving with educational institutions. So right behind religion in terms of categories, and you can see on down the line some of the other various categories that people give to. Again, why people give. This was from a different survey, an opportunity to give back, connection with a cause, having a positive impact in one's community, instilling family and perhaps institutional values, being able to connect with others in a cause that they care about, and being able to help others. Again, tax deductions is not on this list. I think that probably is maybe a little bit more for the professional community than for the primary reasons that people give to institutions. Next slide, Jamar.
So real quick, I'm gonna add a question in here for Michael and for Kirby. So, understanding the basis of why people give is important for the jobs that we do and where they want to get to and how do we connect the dots. Michael and Kirby, can you guys talk a little bit about what you do in the discovery and cultivation step of the donor cycle to better engage and learn what your donors' interests and passions are?
Yeah, I'll start. Jamar, thank you for the question. Obviously when we are meeting with donors and donor prospects, asking questions is key. But I think the experiences that we put them in, we also learn a lot. The thing that I like to point to is, sometimes we, invite donors to the sideline, invite donors to this, men's basketball suite or football suite. One donor that I worked with recently, his name is Frank, who's super stoic and does not get excited about anything. I took him to the men's basketball suite last year and he didn't even crack a smile. But whenever I took him to the football suite when UCF came in town, he was pumping his fist, he was smiling, he was getting geared up. So I know now I learned a lot just from that small experience of taking him to the sideline. And now that kind of tees up this next conversation that we have, because I know now that football is going to be his passion point, and you learn a lot just from those experiences that you put in there.
Yeah, and I think to add to it, and Jamar, certainly thanks for putting this on, and for everybody joining us. I'm big into, especially from a development officer standpoint, right? You can't coach style, so you've got to figure out what that means for you, because the way Michael fundraises, the way I fundraise, the way Jamar fundraises is all very different. For me and people that have worked with me, they laugh when I say this, but my style in discovery is I try as quickly as I can to tell someone I'm there to steal as much of their money as possible, right? Like that works for me. I'm here to take your money, and we're going to work together on figuring out what that is, whether it's today, tomorrow, 6 months from now, 6 years from now. And for me, that helps kind of get it out there, right? It puts it out there to see what that is, and then to kind of figure out what someone's passion or what their interest is. I like to ask the question again in a discovery meeting. Hey, if you had $1 million to give us, what would you give to? Right? What is that thing that you care enough about, that you'd give that $1 million to? And again, maybe they're not going to give us $1 million in that visit or the next visit, but at least gives us a pathway to kind of work on in terms of kind of what their big passionate commitment might be.
Awesome. Thanks, Kirby and Michael. I'll turn it back to you, Scott.
Okay, thank you. So today we're going to focus primarily on the top 4 items on this list. And then depending on how things go and how we're doing for time, we'll maybe do a quick flyover of the items in number 5, which are more advanced charitable giving strategies. So that's our game plan for the tools. So we can go to the next one, Jamar, direct gifts. So thinking from a financial planner's perspective, certainly cash, I think, is the default giving medium. It's how everyone, I think, begins giving. And then at some point, I think people don't realize that there are other options, or they've just always given cash or monthly through ACH or EFT. And so they just continue to do that because of inertia or what have you. But what we found is that clients that have developed an investment portfolio, and this would be beyond, a 401k or IRA or Roth IRA assets. This would be what we call in our business non-qualified accounts or after-tax accounts. Sometimes it's a joint tenants with the rights of survivorship or an individual account, where these assets are subject to tax along the way. And some of them have substantial gains built in. That becomes a very attractive place to another pocket, if you will, for clients to give gifts. And the reason for that primarily is I think of it as discounted giving. So in other words, I'll use Apple stock as an example. If you buy Apple stock and you bought it for $100 and now it's worth $1,000 per share, if you were going to sell it, of course, you'd have capital gains tax on the difference between 100 and 1,000. And many people don't want to incur that type of tax, but they may need to buy other securities or rebalance their portfolio or whatever the case may be. And so rather than giving cash, they could give some of that Apple stock to charity, and basically what cost them $100 and now is worth $1,000, they essentially can make that gift. And when it's given to a charity, charities don't pay tax, of course, and so they can give that appreciated stock at fair market value. In my simple example, $1,000, and that's a very attractive way to give because they avoid the capital gains tax then on that gift. On top of that, many times they're buying more investments along the way, and so we essentially encourage clients to consider using their cash to buy more securities and use the appreciated stock as a way to gift to charity. So I'm just going to pause with those two first to see if Kirby or Michael or Jamar have any comments about that.
Yeah, I'll weigh in. Obviously, we all know cash is king. I think for all of us, our athletic directors, that is number one, first and foremost, that they want that. You tell someone you got $100,000 5-year pledge, and they said, "Why didn't the guy pay it up front?" Right? So we know number one. We know the role of number one. But I had an example a couple of years ago when I was working at ASU. Scott Nelson, my boss, then we went on a meeting with a donor, and we were trying to get him to make a football commitment, and we started talking about $20,000 annual commitment to support football directly. And he committed to it kind of early in the conversation. Scott will jokingly say his style, my style are different. Scott listens. I just keep talking. And so I just kind of kept going. And we got to this idea where Steve finally told us that he was sitting on a bunch of stock from a company that he had just transitioned out of. And we immediately were able to say, hey, forget the $20,000 cash commitment. We need to go all in on that. And once we got it, we turned a $100,000 5-year commitment into a $250,000 commitment just by not accepting right what it was and continuing to dive into what his opportunities and where he could support.
Yeah, I don't have much to add from that. That was pretty great, Kirby. So as you mentioned, cash is king, and obviously all of our athletic departments, for the most part, need cash more so now than ever. And there's a lot of things that play into that, particularly NIL is another thing that is very common in conversations nowadays. So, cash is king. The focus for our athletic department here at the University of Cincinnati is getting as much cash in the door as possible. And I think that is pretty relevant at any other institution or athletics department.
This would be for all three of you. Are you having to engage your donors about considering something other than cash, or are you bringing these up to your donors or your clients about they can use these vehicles as a way to leverage some potential benefits of giving?
Yeah, I definitely think we're needing to educate people. I think, especially in higher ed athletics, right? It's not. There's still donors out there that don't view it as traditional philanthropy, right? So they don't view us as a entity that can kind of accept other assets. And I think for a lot of us, maybe we're working at institutions or have worked at institutions that haven't always been complex enough to accept some of these assets or to explore some of these assets. And I think as an industry, we're getting stronger in this. And certainly where I am now and where I most recently was, we have a lot of avenues to kind of explore this. But I don't think donors have really thought critically about what their kind of asset availability really looks like in terms of their charitable giving.
Yeah, and that's certainly evolved over the years, especially since I began about 12 years ago doing this line of work is presenting, and I'm actually getting better at this along the way, is presenting these options, these giving vehicles, and just creating this alignment with our foundation and the donor. Because again, like you said, Kirby, the educational piece hasn't always been there, but we're getting, like you said, we're getting better at it, we're evolving. Right. It's I think our donor base here at Cincinnati is turning the corner as far as the educational piece when it comes to our giving vehicles here on campus.
And I think too, to add to that, Mike, the idea of figuring out what someone's passion was, right? The question that we started this thing in. What are you trying to achieve with your philanthropy? Okay, now let's look at your assets, and this is what Scott's leading us through, right? Let's look at your assets and figure out how we achieve whatever that philanthropic passion is that you have. And so actually using these not so much for our benefit, but for the donor's benefit.
Scott, anything?
And yeah, Jamar, I would just add one point of clarification from earlier. When I think of appreciated securities, basically the question I think to the donor would be, do you have any assets that if you sold them today, you'd pay a lot of tax on them, right? And
Yep.
Because you may not be getting a full view into their balance sheet, or you may be early on in your discovery process, you may not have all that information, but they're going to know if they have something that's highly appreciated and they're going to pay a lot of tax if they sell it, they will know that. It might be real estate, it could be Apple stock or portfolio of other investments or what have you. Or perhaps if they're a corporate executive, they may have received stock options or restricted stock, some sort of incentive type compensation if it's vested, where they've maybe already paid the tax, but there still is some gain in it. Those are assets that are, if they're willing to part with them, can be really highly valuable assets to give. And then what happens, and we've done this with a number of universities, our experience has been even churches and some of the less sophisticated or maybe the organizations with smaller staffs, even they are often set up to accept publicly traded securities. So Apple stock or Walmart, so that part is in our experience has been pretty easy. And then as soon as the gift is made, they're selling it and converting it to cash. So I just want to be clear that appreciated securities generally in our experience is the gift would be made, and then as soon as the transfer is done, the charity would sell the securities immediately and liquidate them and turn them to cash. So in essence, we think of it as sort of just another pocket to give from that's frankly more efficient because, like I said, they might have paid X for the asset, but now it's worth X times 10. And there's an embedded gain in that asset if they were to sell it. So it becomes kind of a hot target to gift.
Great.
Shall we go on to the next bullet point?
Yep.
Real estate. So again, real estate, some clients have, whether it's farmland in the Midwest or apartment buildings or, investment rental properties, et cetera. And this is perhaps, in terms of sophistication and complexity, more difficult than appreciated securities, certainly. But I think, again, to Kirby's point, there's a growing number of institutions that are finding ways to accept maybe more complex gifts. I think obviously cash is king. So they're probably not looking as much for illiquid gifts to just hold forever. You probably want to sell them sooner rather than later. But I think, again, there can be some substantial embedded gains in real estate assets that can make them, opportune for gifting, perhaps even with some of the more advanced strategies that we might be talking about after a bit. I don't know if Kirby or Michael if your institutions have done any real estate deals or not.
Yeah, we did a little bit at ASU just because there's obviously a lot of dirt out there, a lot of second homes, that type of conversation. What I've realized, and I know we'll get into it further down as we talk through some of these other vehicles. For some of these things, you got to be dangerous enough. I was talked to one of our teammates here this morning about this, being dangerous enough on some of these topics to at least know to ask the question and just make sure they're interested, and then realize, okay, we got to bring in an expert, generally from our campus partners, into the fold to kind of help figure this stuff out. Because I can ask people all day long if they want to donate their house, but once we get that yes, I don't know what we do at that point.
I'm in the same boat, Kirby. I've institutionally we've done a lot with real estate. Athletically, not so much. That's something I think we can improve on, because we do have a lot of our donors and donor prospects with beach homes, homes that they are looking to sell, and that could be another giving avenue for us moving forward. And also another giving vehicle that we can utilize if we start to present that a little bit differently.
Okay, the next one is business sale proceeds. And this could be taken a couple ways. One would be you have a client that sold their business already, and they're sitting on, a lot of cash and a big tax liability. So, in that situation, they've got cash. It could just be a cash gift with enough advanced planning and advanced notice. And this is, again, I think a little bit more on the higher complexity side of things. But I think there are some substantial gifts that have been given where a client might gift a closely held part of their closely held business, whether it's a widget manufacturing company or a farm operation or a car dealership or whatever the case may be. If you can get the planning done before they've essentially signed an agreement, it is possible that some section of the business with the right experts involved could be transferred to the charity, and then when in anticipation that the company will be sold. Again, the tricky part of this is, and this is where you get into tax and legal matters. My understanding is you can't be doing that. If you already have a deal made, you have to sort of do it in advance of having a deal made. Otherwise, I think Internal Revenue doesn't like that. So, but obviously the same concept. You have a low basis stock in a closely held corporation. You're going to sell eventually. When that sale transaction takes place, of course, the portion that's owned by the charity would not be subject to taxation, and that can create, a big liquidity event for the owner, of course, as well as the charity if they're able to make the gift before the deal is done. So those are kind of the two sides of business sale proceeds that I was thinking about. One is more of the deal's already done, and they're sitting on cash, and they're looking for tax deductions in the year of the transaction. And the other would be with more advanced planning, where they might be able to slide some of the stock off to the charity before a deal is done. I don't know if Kirby or Michael have any comments, or Jamar, about that.
No, I think it's a lot harder, at least in my experiences, to get in during the sale process, right? For me, it's kind of been after sale happens and they have that liquidity event, and then kind of being part of that solution, whether it's the tax sheltering or at least kind of understanding what they're doing in terms of DAFs or trust or whatever, to at least be a part of that dialogue. But haven't had any success during the pre-sale process.
Yep. Okay. And then the last bullet point is just sort of an other category. If you're in Iowa and you're a corn farmer, you have a lot of corn sitting around, and you're going to sell it or you're going to keep it. And whenever you sell, of course, you're going to pay tax. So some of the organizations have arranged it so that the grain can be sold or donated rather before it's sold. Artwork, anything that's sort of maybe hard to value or maybe illiquid. And again, this gets a little more complex where you may need to have some other experts involved, but certainly there are other things that can be gifted. Oil rights, I think, for some of the landowners in the South. So we put a category in for other as well.
Maybe sneaker collections for some of the athletic folks.
That's right. That's right. Kirby and Michael have their own card, I'm sure, and it's probably gaining value every day. Okay, next one is donor advised fund, or a DAF. Many of you may know a donor advised fund is a giving account. I think of it again as almost like another pocket that the client can make gifts out of. It's created and maintained within a public charity, perhaps a community foundation or a university or religious organization. Some large financial institutions have now also created donor advised funds. I have found from a financial planning standpoint that for clients who are charitably inclined, maybe they're already doing some of the things that we just looked at on the previous slide, and now maybe that business owner that's had a sale, they're looking to sort of bunch or have a higher deduction in this calendar year because they've got a higher taxable income, or maybe someone's been a public company executive's been granted options or restricted stock units, and they'd like to have a higher deduction and essentially prepay, if you will, or pre-fund some of their future giving. This can be a very easy way for them to do that. So we've had a number of clients that have installed donor advised funds, and frankly, it's often a wider conversation around giving, their tax liability in any given year, and the idea that this is a possibility for them, and that they can get the deduction in the current year and make gifts out of this fund in the future.
Yeah, I love working with donors who have DAFs, because you kind of you can work with them, talk through them, kind of what their strategy is with the money, the principal, kind of what they're trying to accomplish. There's a donor I've worked with indirectly who has he put $1 million into a DAF, and this was kind of pre-COVID, and so he was riding the ups and downs of the market. And his whole strategy was every time that $1 million accrued 10%. So every time it got to 1.1, he'd take $100,000 out, send that back to the institution, and then he still kept his million in. And next time it grew 10%, he kind of did that same thing. And so you can kind of start depending on that a little bit, understanding what the strategy is. I think it puts some onus on accountability on the charity, right? Or in this case, on us to make sure we're delivering, because they're not just giving all that money straight to us. And so we know that it's out there, and they're kind of keeping a carrot out there for us year by year, or however they're kind of navigating and managing the DAF to make sure we're doing everything we need to receive their money.
So Scott, if we look at this in an illustration format, shout out to Texas A&M Foundation for the graphic, but go ahead and walk through this from a simplicity standpoint.
Yeah, it really is pretty simple, and we did this because we like the graphic. No special privileges here or anything, but in step one, the donor gives the assets or cash to the donor advised fund. Donor advised fund can then make the gifts to charity. Unlike some of the other instruments out there, they're not required to send a certain amount each year. They can sort of do so as they wish. As Kirby mentioned, as it grows and such, they can take more out or leave it in. And I find that it's just, it's like having another sleeve of money. And one other thing I'll mention, just from a financial advisor perspective, behavioral economists use a term called mental accounting. And there are some other strategies as well. And this is some of it's just human nature. But I think that, if you think about cash and you think about appreciated securities and you think about DAFs, I would imagine that from a fundraising standpoint, if you have a client that has all three of those things, or at least two out of those three things, it's probably an easier conversation. You're not competing with all the other reasons or all the other things they need cash for. And I think, certainly with a DAF, once they put the money in there, it's got to be used for, charitable gifts. And so you already have it's like having a third pocket that you can, go to. And I think the appreciated securities, because of the tax consequences, and many times if those securities are given as part of a transaction or an incentive award, it feels different to the client than their cash. So for whatever that's worth, but this is a graphic of the DAF. It's pretty straightforward, and DAFs can also receive other proceeds from some of the other advanced charitable strategies that we'll talk about after a bit.
So Scott, donor gives cash or an asset, they get a deduction, and then the donor decides what to do and how they want to support a charity. And so that's where we come in and have conversations with them about, this is one of the vehicles they can support our institution, right? And these donor advised funds can either be endowed or expendable, depends on where they're set up. And they can start at 25 grand to 50 grand or to 100 grand to be endowed. It depends on the institution, right? A little range there on how they're set up and used.
Yes, I've even seen them set up as low as $5,000 or $10,000, and the gifts just have to be made to qualified 501c3 nonprofits.
It is interesting. I'll say this. I know we probably all don't want to hear about NIL on every call we're on, but we'll bring it up. There, as we're kind of navigating collectives, being 501c3, not all that. We are starting to see some of these DAF agencies, right, or these charitable agencies not make commitments to collectives that are claiming 501c3 status. So that's just something to keep in mind as you're working with donors, or you're trying to say, oh, our collective, we're a 501c3 over here. That I've had a couple instances recently where Schwab, and I think it was Northwestern Mutual, said we're not gonna grant that fund. So just something to keep in mind. That's
consistent with my experience as well, Kirby.
Scott, and there's really no time frame in how and when those dollars can be used, correct? There's no someone who sets one up doesn't need to use it right away. There's no real time frame in when the donor needs to expend those funds.
That's correct.
All right, you want to roll on to IRA?
You bet. QCDs, we're good with acronyms. So individual retirement account, qualified charitable distribution or rollover, allows individuals age 70 and a half and over to make direct transfers up to $100,000 per year to qualified 501c3 and satisfy their required minimum distributions. So a quick primer on this. First of all, there's been some changes with the Secure Act 1 and Secure Act 2 over the last few years that's pushed the required minimum distribution age. It, for many, many years, was 70 and a half. This is the age, RMD is the age at which, if you have IRA assets, you have to start taking some of the money out annually. Secure Act 1 and 2 essentially started pushing that back, and it will continue to do so, but that did not change the 70 and a half time frame for purposes of qualified charitable distributions. So anyone that has IRA assets and is 70 and a half now, they can make these direct transfers to a charity up to $100,000 per year. I think of this as the Uncle Sam matching gift program. If you think about it, you have a 401k, you're making pre-tax contributions during your working life, company or schools matching, you end up with millions of dollars in your account, and then when you start pulling the money out in retirement age, you can start it pulling out at age 59 and a half without penalty, and you have to start taking it. Well, now depending on your age, it's 72 or 73, but previously it was 70 and a half. Well, that is taxed as ordinary income, and so the formula is about 4% of your account balance. So if you've got $1 million account and you're in your early 70s, it's going to be roughly 4% to start with. It's actually an actuarial calculation, but the equivalent is about 4%. So that'd be about $40,000 a year if you have $1 million account balance. And some clients don't really need that money, or they'd rather not pay the tax on it, or they'd like to defer it, but they can't. So for clients that are charitably inclined, or they're already giving to charity, instead, we can use these dollars. And if the money goes straight from the IRA to charity, it is tax-free to the individual. Now, they don't get a tax deduction for it because they got the tax deduction before, but it does satisfy the required minimum distribution. So this is also, I think, a great play. It's kind of a no-brainer for clients that have these assets. They don't really need the income, and they're giving gifts anyway, and they meet this demographic. The bottom line says that we can't use it for private foundations or donor-advised funds, but for clients that are in this age range and have substantial IRA balances, the IRA assets are not great assets to transfer to the next generation anyway. So getting these assets to charity for those folks who are inclined can be really advantageous.
So Scott, correct me if I'm wrong, but that's $100,000 a year that each person can do. So a husband and wife could do $200,000 total, 100 for each person, right?
That's correct. That's the maximum per year.
And so Kirby and Michael, do you feel donors understand this benefit and this way of giving?
Oh yeah. So Jamar, I believe we're doing a better job, and I think, like I mentioned earlier, we're evolving as we continue to talk about this vehicle. I think here at Cincinnati, I believe that this is probably our second most common giving vehicle outside of cash, of course. I think Dash kind of follow maybe third. So we have a lot of people based on our demographic here that a lot of people they are 70 and a half or are looking to support through their IRA or QCD at that moment to support our athletic department.
Yeah, and I think it's another example of a solution, right? You talk to someone in their mid 60s, late 60s, hey, what are you trying to achieve? Knowing 2, 3, 4, however many years down the road, this becomes a solution for them to kind of start achieving some of their philanthropic priorities. We might have to educate a little bit on the front end, but I think once they know that this can kind of help them achieve what they're trying to achieve, it becomes a big solution for everybody involved. I know we all have probably tried to figure out, okay, if we can just get to that age threshold and we can put a whole big campaign around it, we're going to get a lot of money. And I don't know if anybody's truly figured that part out, but certainly in one-on-one conversations to be mindful of this and make sure to bring it up so that you're part of the planning when people are considering QCD, RMD contributions, all that good stuff.
Scott, I know you do a great job advertising your clients on this, but generally speaking, do you think professional advisors can and should do more to educate their clients about this way of giving and the benefits of it?
Absolutely. In fact, this isn't that old. I think it came out of Secure Act 1.0, if I'm not mistaken, the ability to do this and have it qualify. So, these things are always changing. And I think demographically, if you've got university employees, for example, or W-2 wage earners who have worked, for 30 or 40 years, and they've been getting 5 or 10 or 15% contributions between their money and the company match in a qualified plan, they're going to have large IRA balances. And that, in fact, may be where most of their wealth is. So this is a great tool for them. Also, corporate executives who, have been putting a lot of money in their plans. Business owners, maybe not as much. Business owners might be more of some of the other things we talked about. But yeah, I think it's all education. And I have one situation where we're doing this, and we're also making gifts with appreciated securities to satisfy a 5-year commitment to a university. So again, these things aren't mutually exclusive. It could be a matter of a few things along the way.
I had a question asked. This might be Kirby and Michael for you guys. Have you guys done a mass mailing or solicitation to people that are 70 and a half specifically regarding this giving opportunity? And if so, have you seen successes with it? Or I think Kirby, you kind of noted it's been a hard nut to crack, but Kirby, Michael, your feedback?
That would be a no from our team. But I am curious to hear from Kirby, because if this is successful, then obviously that's something that we have to implement here. But I am curious to what you have to say, Kirby, because we have not implemented that here
we
thus
haven't
far.
we haven't done anything formal here at Maryland yet, as we're kind of figuring out what that solicitation cycle, strategy, segmentation, all that good stuff looks like. We did do a standalone send a couple years ago when I was at ASU. I don't think it turned anything in the immediacy, but I think it's like a lot of these gift planning vehicles. We shouldn't expect probably immediate ROI. It's more on the educational front. And so I think it's partnering with your central gift planning team, making sure there's some athletic play into it. So donors who are receiving some of this stuff kind of recognize that athletics can be a beneficiary of some of these strategies. But that's something we're going to work on, is a little more complexity around, okay, the multi-year build up to what this kind of educational platform can be for people.
Okay, and this is a rather basic slide. I just realized I missed an arrow. It's supposed to be an arrow going over the IRS. So from the donor right to charity. So just imagine there's an arrow over the IRS. Not that you're still meeting the satisfaction of the required minimum distribution, but the money's not going through the hands, or the tax isn't going through the IRS. So that's what that was meant to show. Okay, and then item 4, estate gifts. So this again can get a little bit more complex. One thing I'll say is I've seen cases where a beneficiary has their children listed as the beneficiary of their IRAs, the secondary, so husband and wife primary, and then children secondary on the IRA and the 401k. And you say that sounds reasonable. And that's typically how it would be to start with. And then when it comes to their life insurance, they have the spouse as primary and charity as secondary, which doesn't make any sense to me. So in that situation, it was really just, I think, they wanted charity to receive some of the proceeds of the insurance, but life insurance proceeds are income tax free to beneficiaries generally. And so IRA assets and 401k assets are not. And so in that situation, what we did was we just had them flip around the secondary beneficiaries. We had the charity named in the IRA 401k assets because that's ordinary income, but not to a charity. And we had the children as the secondary beneficiaries on the life insurance, so that everyone wins that way. So sometimes these beneficiary arrangements, which is how life insurance, annuities, IRAs, 401ks, all of those assets transfer by beneficiary designation. Sometimes I think people misunderstand that a will or a trust doesn't necessarily preclude what the beneficiary says. So certain assets transferred by beneficiary designation, others by will and trust. And so paying attention to those beneficiary designations makes a lot of sense, but can be easily overlooked. And then wills and trusts, of course, they can be changed, they can be challenged, but certainly there are provisions that can be made within a client's estate plan to affect, their charitable intent. And the reason I wanted to put all of these on here is just to, understand the interplay between these things, but also not to underestimate the importance of keeping those beneficiary designations current.
Yeah, I think this is where you figure out how to get buddy with your campus colleagues who are experts in this. And as soon as someone says one of these words, you say, here you go, let me introduce you to this person. But I will say, and I think for all of us as frontline fundraisers, the easiest way, Scott Nelson at ASU always says this, the easiest way to add a common 3 zeros to gifts is through estate gifts, right? And so we're all fortunate that we're judged by the cash we bring in, but we're also judged by the commitments that are made. And this is an easier way, I think, to hit some numbers and some targets when we can kind of play off of people's overall wealth a little bit and explore some of these things.
Okay. Jamar, how are we doing for time?
I think we're doing pretty good. Wrap up with some of these
Okay.
comments.
Yeah,
Answer.
we'll go faster with this. I think everyone will get a copy of the deck if they want it, right? So they can read more about this later. So we've got a charitable remainder trust. This is a pretty common, more advanced strategy. Provides a donor with cash flow while obtaining current year personal income tax deduction. Generally contributing an asset that makes annual distributions. And there's a lot of different options with charitable remainder trusts, right? And I won't go into all of the acronyms today. Jamar, if you can go to the next slide, we'll just show the kind of the flow chart on this. So generally the assets go to charity, go into the trust with an annual payment back to the donor, and at some final point, be it death or a term, then the remaining assets go to charity. And that could also include a combination of a donor advised fund potentially as well. Okay, charitable lead trust. Again, there are different versions of this, CLATs and CLUTs. It's designed to result in tax-free gifts to the donor's family. It's done by first donating assets into a trust, which then provides one or more charitable organizations with cash flow for a certain period of time. Assets remaining in the charitable lead trust upon termination pass back to the donor's family, subject to gift tax rules, and there's some lifetime exemption, which is beyond the scope of our discussion today, that's required for that as well. And so this is sort of the similar concept. It's just that where things go in the end, the payments go to charity, whereas the remaining asset goes back to the family. Wealth replacement trust. Sometimes the question is, okay, we're going to include charity in our estate plan or make a major gift, but we don't want to disinherit our children, or there are other obligations that we have to honor. And so sometimes there are strategies where you can put other assets aside to provide for other parties, be it family or otherwise. Sometimes that includes something called an ILIT, which is an irrevocable life insurance trust, which is generally designed to hold either a single or a second to die life insurance policy. These plans were much more common, I would say, when the federal estate tax exemptions were a lot lower. Only time will tell at the end of 2025 if our federal estate tax exemptions will revert or stay the same or go down, or it's anyone's guess. Anyway, wealth replacement trust is a way that you can essentially refill the drawer, so to speak, for gifts, large gifts that are made to charity. Okay, go ahead, Jamar. And then a private foundation. It's an independent legal entity set up solely for charitable purposes. Unlike private charity, it relies on public fundraising to support its activities. Generally, it's large gifts from the donor. And in my experience, or perhaps a corporation, they receive a tax deduction for the donations. And private foundations do require, I believe it's a 5% distribution per year. And of course, there are substantial reporting and compliance and accounting provisions. This is not something that you just want to do haphazardly or, on a whim. Professionals are needed for this. And I think we might have a comment from Kirby or Michael about this. We also put in just a chart that shows some of the differences between a private foundation and a DAF, and why some folks may want one. In my experience, DAFs are very common. They're very easy to set up. It doesn't require a lot of money. The compliance function is relatively straightforward. With private foundations, it's sort of the opposite. I think in my world, I don't think you're going to probably set up a private foundation unless you're ready to put in 2 million or more in assets, just because of the costs and compliance function and requirements. That's just kind of our number. There of course are fees and costs associated with setting these things up. So I don't know if Kirby or Michael have any experience or thoughts on where private foundations come in.
Kirby?
No, and the only thing I'll add, I guess, with private foundations, everything from charitable lead trust, remainder trust, everything you mentioned. One of the things that I think, right, there's a lot of acronyms. They scare me. I'm sure they scare everybody. What my experience has been, and Scott, I'd be curious, you from the advisor standpoint, if you've had this, where donors kind of come to the table at times. We had one recently here in Maryland where we had a donor looking at a $200,000 charitable remainder trust, and went through the process, all the illustrations, all that. And as he was kind of contemplating, he decided, you know what, I'm not going to mess with that. I'm just going to hand you a $200,000 check outright, right? They get exposed to all this, and whether it's because of the complexity or their life situation changes, they don't end. It's more of an educational tool to open up the door to all the gifting vehicles. But at the end of the day, they end up going with a more direct gift, whether it's cash, securities, whatever it may be.
Yeah, definitely. Some of these advanced charitable planning strategies are quite complex. And, I think a client that favors simplicity and does not want complexity, that might be a reason, by itself for them not to do it. So certainly it's educational and understanding what their goals are. If they need income, or, there's a lot of different motivations that these tools, if they're looking for a big tax deduction, some plans are better than others.
I would say in my experience, it seems like some of our higher net worth donors just go the donor advised fund route because they don't have to do the 5% required spend out and the administrative overhead. It's just easier to set up as a donor advised fund and just make grants out of that as well. Let's chat about, obviously we have a professional advisor on the phone here with us or on the call today with us, but collaborating with professional advisors is certainly key in our work. These are the people that are educating our donors on opportunities and advantages of gifting in certain ways. So obviously you have the attorneys, those folks who work hand in hand with a lot of the legal matters, the CPAs who are more involved on a day-to-day, month to month, as well as financial advisors, and then real estate professionals as well for appraisals and other assets. Michael, Scott, Kirby, the importance of how important, I guess, is it to have good relationships with professional advisors when trying to work with your clients or donors?
Jamar, it's critically important. It is critically important. I think the advisor, as they do their assessment, they can minimize or shrink the gift potential in which you're trying to seek from that donor. It is critically important to build a relationship with that and a good rapport with the advisor. As I continue to think about a state advisor, in all of my stops, I took it upon myself to go out and build relationships with state advisors and treat them like a donor, and create that partnership. And one thing that has been for me is relatively advantageous, because now they are sending people my way that aren't really on our radar, that are looking to do a planned gift. But at the same time, I am sending people their way that does not have an estate advisor, and I'm sending people that. So it's a great partnership. And I try to treat them as if they were one of my own personal donors, and they were part of my portfolio. So it is critically important to have these relationships with with the advisors of your donors, because again, they can sway the size of that gift by the time documentation begins.
Yeah, I think they're critical gatekeepers, right? To being trusted to what a donor may do. And even like Michael said, even if you're not working with an advisor for a direct donor, but as you're building rapport and relationship with any number of these industry advisors, they are also working day to day with our high net worth individuals, right? So they know what our donors are thinking about the organization, what the talk on the street is, if you will. And so that can help kind of guide how we engage with those donors. I think, yeah, the advisor relationship is sometimes a little wonky and create some challenge, but they're important to the overall kind of relationship and cultivation of a donor.
I have a couple questions here. One of them is relevant to this real quick is if a donor tells you they need to talk to their CPA or financial advisor, how do you work through that to get through the brick wall, if you will, the gatekeeper?
Yeah, I offer to hey, have them connect with us directly, right? Let us kind of be a part of that conversation. I'm working with a donor right now in New York who kind of said that about making his final payment on pledge. Oh, I got to get with my advisor. Give me the person's number. I will reach out to them and I'll have that dialogue. And sure enough, he's now giving me that phone number so we can kind of start that process. And again, it's adding to our whole relationship with that donor.
100%. 100%, Kirby.
Well,
Jamar, I would
great.
just add that I think it's also critical, it's relationships, just even being able to get these things done, right? If you have a working relationship with advisors in your area, that will just make doing business much easier. You'll have a trusted relationship and obviously referral opportunities as well. And, I think many professionals these days are so busy doing what they're good at, it can be hard to sort of look up and look around and do that. But I think it's absolutely worth the time of investment to be able to collaborate together. And, again, no one has a corner on the market on good ideas. So many times, things that they may not be as familiar with. And so being able to collaborate is really important.
Absolutely. I had a comment come through about an attorney or professional advisor is a game changer, having a well-known one, and bonus if they'll give you a time to benefit your university. So I would echo that for sure. A couple quick questions before we wrap up. One is regarding donor advised funds. Is the advantage of a donor advised fund accumulating interest for donors? Is the question. I'm assuming accumulating, is there more interest from donors that are you guys are working with?
So I read that more as growing securities, growing value.
Sure.
And so when I asked that, I think, and Scott, probably more for you, more tied to a important kind of financial liquidity event, right? And so in a lot of ways, they might cash out at $1 million and they're not ready to give $1 million all to one area, or they don't know what that looks like. And so to take advantage of the tax solution tied to it, they go ahead and start the DAF with $1 million, then that gives them time to decide where they want to send that money.
Yeah, and I would just add that whatever the money's invested inside the DAF, it should grow over time, using Kirby's example. Right. So yes.
Another question that came through: have you seen certain asset types over others be used to fund CRTs? Scott, this is probably for you.
I would say generally they're appreciated assets. So it could be real estate, it could be stock. So it's generally appreciated assets. And that gets back to fact finding and discovery of what they have on their balance sheet.
Great. Well, that wraps up our time. There's our disclosures from Scott, as we have to do.
Thank you.
But wanted to thank you all for taking time to join us for our NAADD session today, the first of the development series. We hope you tune in for some more sessions as we go throughout the year. Thank you, Scott, Kirby, Michael, the whole the whole staff at NAADD for helping us lead this discussion today, and hope you tune in here very soon. Thanks, everyone.
Thank you.
Thanks, Jamar.
Thank you, Jamar.